Why you shouldn't listen to property gurus telling you to buy property in a company. They want to trap you forever. Let me tell you something that's probably going to annoy a few property gurus right now that's online. Anytime someone tells you, oh, just buy a property in a company, lower tax, better compounding, deal with CGT later, end quote. And I want to stop and ask one thing. Who does this actually work for? And who does it quietly trap? Because yeah, on Instagram, it sounds genius. But if you zoom out and actually follow the decision from purchase, holding, exit, a very different picture shows up. In real life, I've watched everyday Aussies walk into structures they can't get out of without bleeding money. And the worst part, the math isn't totally wrong. It's just dangerously incomplete. Today, guys, we're finishing the maths, and not just the part that fits into a 30-second social media reel. So today, folks, this is what we're unpacking. Today, we're unpacking 5 claims property gurus use to sell company ownership as a tax hack, and why each one sounds right, but quietly falls apart once you follow it all the way through. We'll talk about, oh, quote, company tax is lower, so you compound faster, end quote. Or, oh, you can always deal with CGT later, end quote. Or, companies save land tax. Or, companies or trusts are always better than personal ownership. Or you hear this often sometimes, franking credits and retained income make it all work. And yes, guys, I also tell you when companies actually do make sense, because I'm not biased against people using companies to buy property. I'm just getting shitty when property gurus use it as a one magic bullet that gets the noobs out there to buy property under company structure, so these property gurus can make bank on their property coaching that they sell to you. Because guys, this isn't about dunking on structures. It's about calling out the advice that ignores real life threats. So firstly, guys, let's talk about why buying property in a company sounds smart, but actually quietly breaks most people, especially the noobs. Now, before we jump into company versus personal name, we need to slow this right down, because I got a lot of noobs that's watching this channel. Because if you spend any time in property content online, you'll hear the same confident lines. Oh, serious investors buy property in companies. Or stuff like companies pay less tax. Or you'll keep more money working for you if you buy in a company. Like, it sounds smart, it sounds sophisticated, and most beginners just nod along and go, yep, without realizing what's being assumed. So before I roast anything, let's translate the jargon into plain English. What does buying property in a company actually means, Q? Now, first of all, when you're buying in a company, it doesn't mean you're being more professional, and it doesn't mean you're buying shares, and it doesn't mean magic tax hacks. What it means, guys, is that you set up a separate legal entity called a company, and this company buys a property. And then we have rent that comes from this property. It goes to the new company that you set up. And also all the bills surrounding this property will go towards this company. And also, as you commonly hear about tax or property tax, that is also paid by the company. Now, when you buy a property under a company, you personally don't own the property. You own shares in a company that owns the property. Now, right now, that distinction feels small at the start, but it controls almost everything later, especially refinancing, selling, and especially accessing your own money, which is equitable. And now, right now, you must be scratching your head thinking, hey Q, why do people say companies are better for tax? Now, this is where the sales pitch starts when you speak to those so-called property coaches or gurus. Now, right now, as a basic knowledge, individuals can pay tax up to 47%. Versus when you buy in a company or a company structure, companies usually pay tax between 25 to 30%. So the logic goes, if the income is taxed lower, there's more left to reinvest. Now, a lot of people would take that and go, oh yeah, that's kind of reasonable, Q. But guys, only at a very specific condition that almost never gets stated up front. Because when those property gurus say this, they don't tell you that there are 2 scenarios this advice quietly assumes. So when gurus talk about, oh, keeping money in the company and compounding faster, they're assuming one of 2 conditions, scenario 1 or conditional 1. And it's very rare, this condition, but technically possible. So for example, the property itself that you buy produces real surplus cash after all costs. So that usually means very low or no debt or exceptionally high yield. And from that basis, meaningful cash left over after interest, maintenance costs, vacancies, and other miscellaneous buffers. Now, I don't know about you, but in today's property market, that's usually commercial properties or specialized assets like NDIS properties, childcares, boarding houses, rooming houses, or maybe on the other spectrum, high yield regional stock bought well or residential property owned outright or close to zero debt. Now guys, think about it. When you're buying a property right now, this is not the typical metro property most beginners would buy, right? You can't expect a noob with little money, maybe a lot of serviceability, to go buy a commercial asset like that. Those commercial assets are at least $2 to $3 million to start off with. Now, right now, I'm going to talk about condition 2 or scenario 2. And most gurus really jump into this when they're selling about buying property under a company. They're already assuming that you're running a very profitable trading business through a company. But you know what? 80% of people that contact those property gurus, they're PAYG, payslip applicants. They get paid from an employer. They don't run a goddamn business. But hey, assume that you run a very profitable business. They also assume, the property gurus, that the business produces surplus profits every year, and like for example, money you don't need to live on. And that's the profit that those property gurus are talking about. They're not talking about rent. They're not talking about property cash flow. They're talking about business profits. Now, this distinction is where most beginners or noobs get misled. Because when they hear that property advice, which by the way, most of the property gurus should not be giving advice, but you know, wink wink who I'm talking about, bloody giving advice like their PhD of property investing, but you know, they have no diplomas. Most noobs that set up a company to buy a property, that company is a shell company. And outside of that shell company, in terms of when they receive wages, those wages are already taxed. But then the gurus that are talking about the companies that are having a lot of profits, they're talking about existing companies that are making a lot of profit that has additional profit to be used towards buying future properties. Again, I'll be talking about more about this mismatch if you're scratching your head and go, Q, what the hell are you talking about? But I just want you guys to be careful when gurus say, oh, don't pull the money out of the company because you can use that money to reinvest and buy more properties under a company. They're not talking about rent, guys, because the property you're going to most likely buy, that property is not going to produce a profit for you. They're talking about ideal clients who run a profitable business, and they're talking about business profits sitting inside a trading company. And in their sales pitches, when they're selling companies to buy property, they're talking about the choice of pulling profits out personally, then pay personal tax, or leave them inside and pay company tax. Because when you're leaving money in a company, that is tax deferral, not tax avoidance. So you're not actually escaping tax, you're just pushing it into the future. Again, guys, if you're scratching your head and thinking, hey Q, what are you talking about? What? I'm PAYG. What has that got to do with the company? Why is the company producing a profit? I don't get the distinction. Let me give you an example. Let's just say we have two clients. We have Ben and Alex for illustrative examples. They have the same property, same price, and the same property market that they exist in, which means they both have the same growth. The only thing that changes is how they earn money, guys, and where that surplus cash exists. Now, for Ben on this side, he's PAYG. That's his reality. He gets pay slips from an employer. Now, for example, Ben is a software engineer. His income is $165,000. He buys a $720,000 apartment with a large loan, and the rent roughly covers the interest rate, which, by the way, doesn't exist in 2026 or the years beyond that when you're watching this video. Now, let's talk about the property's expenses for Ben's property. Now, the expenses are interest repayments, strata, council rates, and insurance. And just say the rent covers all that, there's no surplus cash. So when you hear a property guru say, hey, use a company to buy a property, or they say something like, oh, would you rather lose 20 to 25% of capital every year or pay a bit more tax later? You know, that's this typical sales pitch for getting people to buy property under a company, right? Now, right now, if you're applying to Ben's example, he's thinking to himself, what capital? I'm copying this thing up myself. And there are no small taxes every year being avoided right now because there are no profits. So the trade-off doesn't exist, because remember this, when CGT enters capital gains tax, say for example, years later he sells the property and he makes a $400,000 gain. If he held this personally, he gets a 50% CGT discount and a $200,000 taxable debt under CGT, which around 47% tax, like I'm just being very rough, it's around $94,000. And say, for example, Ben listened and bought this property under a company, there's actually no CGT discount. The $400,000 profit he gained from selling this property will be taxed at 30% tax. That equals $120,000. Now, I don't know whether you can do the math. I don't see a way that Ben saved tax along the way by buying under a company. He just paid more tax at the end of the day. Now, right now, let's look at Alex. And this is where the timing argument actually works. Now, Alex over here runs a consulting business. Similar like mine, I'm providing holistic lending consulting to, investor clients. Alex's annual profit is $300,000. His living cost is $120,000. So his surplus every year in terms of the company profit for what he needs to live on is $180,000 every year. Now, right now, Alex buys the same property through a company. Now, each year, Alex from his company assigns himself a director's wage or a director's income. Now, this personal income is taxed at 47%, assuming he pays himself over $180,000 or $190,000. And the rest of that profit, he leaves it in his company, which is taxed at 25 to 30%. Now, if you do your basic maths, and I don't want to bore you out because this is going to be a long video, that's roughly a $40,000 per year in tax drag avoided. So over 10 years, guys, from his business, he retains $400,000 because 40,000 times 10 is $400,000. So right now when Alex sells, yes, higher CGT in a company, but he already saved tax every year. So as you can see here, Alex benefits from buying property under a company because he's a business owner. He can slice and dice his income versus Ben, he's PAYG. He can't slice and dice. He can't go to his boss and go, slice and dice my income so it's in a way effective with my property strategy. However, if you're looking online with all the ads being sold from property gurus, a lot of beginners and noobs are sold Alex's strategy as if it applies to Ben. So they're selling a strategy that's suitable for a profitable business owner to a bloody PAYG noob, which is 80 to 90% of those leads that goes to those property buyers agent coaches. And once you understand the difference, because I know right now you're scratching your head and go, Q, this still doesn't make bloody sense. I'm sorry, I can't drag this video out for any too longer, but just rewatch what I just said. Once you understand that, we can talk about what happens when people try to fix it later. So in this segment, guys, segment number 2, we're going to talk about the exit nobody mentions. We're going to talk about stamp duty, CGT, and flexibility. This is the part gurus almost never lead with. For example, if you buy property personally and then later decide, oh, hey, I should move this into a company, and like, oh yeah, I'll be more sophisticated. I'm telling you right now, the system doesn't say, oh, nice upgrade. We're going to give you all the tax perks because you've decided to move your personal property into a company. Because when you try to do that nice upgrade, for example, you have an existing property under a personal name, you listen to some bloody company structure webinar, and you got sold the idea to move your personal property that's under your personal name and upgrade it into a company. Despite all the brainwashing that goes on, what happened is you made a sale from your personal entity to a company entity. That's treated at a sale at market value. And you know what happens? Stamp duty gets triggered immediately. Let me give you another example, guys. We have Ben over here, right? He buys a property personally at $720,000. A few years later, the value is $900,000. He again went to some fancy, savvy company structure webinar, and he got sold the idea to transfer his personal property into a company name. And right now, I'll show you what the stamp duty bill is. It's from $40,000 to $45,000. And from that transaction alone, there's no equity gained. There's no leverage improved. So what does he get at the end? He gets a check from state revenue just to reshuffle ownership. And then later, he still loses out in the CGT discount. So what happens is Ben, the PAYG so-called property investor, gets stumped with stamp duty on the way into high CGT on the way out. Now, guys, that's not optimization. That's a double hit in the gut. However, guys, when you apply this strategy to Alex over here, the successful property business owner, Alex doesn't get burned here. For example, Alex buys in the correct structure from day one. There's no transfer, no stamp duty event, and no retrofitting pain. And the reason this company structure strategy fits Alex more, for example, how he actually funds multiple properties, Alex over here doesn't just leave money in a company. He actually uses something called a Division 7A. That's called a compliant intercompany loan. That's right, guys, getting a bit technical, but stay with me. What that means is the trading company lends money to the property holding shell company that he sets up to buy that property, and they set up a proper loan agreement between each other with interest repayments. That money that gets transferred from the company profit to the new company, for example, the deposit, the buffer, that intercompany loan to buy this new property, there's no PAYG tax, which means there's no personal tax, and the money stays inside the corporate group. And for this strategy that applies to Alex, that's how tax timing actually works. And for example, if we apply this strategy to Ben, what's going to break Ben is when rates rise. For example, if the property costs $900,000 and Ben took a loan of $700,000, the interest jumps to 6.5%, but the rent doesn't keep up. For Alex, the property company can run at a loss. And yes, it's tax deductible. But for Ben here, the tax losses don't pay interest bills. For Alex over here that runs a profitable business, every year he's getting a lot of gross income, a lot of turnover. Alex can actually inject more cash into this shell company to keep it alive and still claim tax. But for Ben, who applies Alex's strategy, this poor PAYG noob, he cannot do that. That's why it's not the same structure. And that's the brutal truth, guys, that I want you to get out of this video, right? Companies don't make property safer. Surplus profits do. It depends on the source of income that's funding this property portfolio. And sad to say, not a lot of people realize that. And when it's too late, they usually try the next thing, which goes to segment 3 of this video. Land tax, where company versus trust gets expensive. Now, right now, this is where people think, okay, personal name isn't perfect, but I'll be smarter and use a company or trust. And this is where the annual damage starts again. In New South Wales, guys, personal owners get a land tax threshold. Like the general threshold is currently around $1,075,000 of taxable land value. Now, land tax is based on combined taxable land value you hold. So if Ben owns one property personally, under that threshold, there is no land tax. That's of course, it's under that threshold. However, a lot of people or property gurus will also argue there's also one legitimate benefit: people buy properties under companies. Like for example, they can reset the threshold idea. Like for example, they say, oh, it's a new entity. It could reset the threshold. Now that's kind of actually true, but also not true. So you got to really look into it. Don't take it for granted, because a company can access the land tax threshold if it's treated as a concessional company. So yes, in that situation, a company can have its own threshold like an individual. But before you jump out and go, woo, the gurus are right, the gurus are right. Like when the gurus give you that sales pitch, oh, just buy each property in a new company and keep resetting the threshold. Woohoo! But the missing part is, especially in New South Wales and I'm sure in other states, the rules are designed to stop threshold splitting. Which means, for example, they have this thing called related company grouping provisions, which is aimed at preventing companies under common control from splitting land holdings just to claim the threshold again. So right now, if you're scratching your head and going, Q, speak in plain English. What I'm trying to say is, if you control the companies or the same people control them, Revenue New South Wales can treat them as a related group, and your multiple thresholds fantasy can get folded back into one reality. And this is where, if Ben goes along with these property guru strategies, this is where he gets tricked, because if Ben buys his first property in a company, he might get a threshold, only if he qualifies properly, of course. He has to have a really good accountant to set that up, right? And for example, if he tries to spin up multiple companies, he might get away with getting every property under a new threshold and go, yeah, I'm escaping land tax. But if he gets out of control, the police will slap him down with a related company rule. And say right now, Ben calls his property guru coach and go, oh no, they're cracking down on companies. And the guru is like, hey, just buy in a discretionary trust. Let me tell you one thing, guys. Many discretionary trusts are treated as special trusts. And when you buy a property under a trust, it can be taxed from $1. There is no land tax threshold. And if Ben listened to this willy-nilly without doing his own due diligence, this is where Ben ends up every year with land tax every year, no surplus cash flow, and no easy exit with stamp duty again. While for Alex over here, the profitable business owner, to him, land tax is just a managed cost. It's like running a company and it's just expense. I'll just expense it out. And right now, if you're staying thus far to this long ass video because maybe you're a fan or maybe the information is very relevant, I'm going to talk about the brand new property and the GST trap. This is the part I talk about how Ben and most noob investors accidentally become a developer. This is where everyday investors accidentally level up into tax complexity they never asked for. For example, brand new property sets up a brand new company. Even a hint of profit intent can trigger GST. For example, you set up a property. You own a lot of properties under a company. What happens is a TAX office can deem you as a professional property developer. They can apply GST to all your profits. This alone can drag down your profit margins and really shrink your buyer's pool when you sell. Let me give you an example on how GST can quietly show up for Ben. For example, Ben is still a PAYG payslip receiving employee. He's still that humble software engineer. who has these property dreams. His income is $165,000. Currently right now, he has no business, no intention to develop, just wanted to get a smart structure. Now, in the last 6 months, Ben buys a new townhouse in a company. And right now, you might be asking, Q, why did he do that? Because he was told companies are better for tax, more flexible later, more sophisticated. So what happens is, on that 6 months plus a few years have passed, Ben decides to sell. Now here's the surprise. Because the property was branded new when he bought and it was held in a company, and there's a clear profit on the sale, the TAX office doesn't see Ben as a passive investor. And they start asking questions like, Ben, is this an enterprise? Is this the intention to make a profit? Does GST apply? Now, right now, Ben is sweating balls, right? He's dealing with GST advice he never budgeted for, and there's a thing called complexity creep. He's involving lawyers, accountants, financial planners, and even brokers like myself to unwind him out of this trouble. And you know what the kicker is, guys? Even if GST is handled under the margin scheme, the follow-on effect is that it reduces the net sale proceeds, which complicates the contracts and makes some buyers walk away. Now, a few years ago, Ben never wanted to be a developer, but his structure pushed him halfway there. And this is where Ben got misled, right? Ben only wanted boring growth, he wanted flexibility, he wanted a clean exit, but instead he got more admin, more tax uncertainty, fewer buyers, and a mess he didn't plan for. Like, for example, don't get me wrong, this structure is great if you are actually developing. However, it's brutal if you're a PAYG investor who just wants to buy, hold, and sell. Now, in the next segment, I'm going to talk about franking credits and the tax later fantasy. Yes, folks, companies can retain income. And yes, folks, franking credits exist. But this is the part most people misunderstand. Franking credits don't erase tax. They just prepay it. And whether that helps or hurts you depends entirely on when you actually need the money. For example, let me show you how this works in real life. And again, we have poor old Ben, right? In this scenario, Ben's on $190,000. No business, one investment property. He bought through a company after being told, just leave the money in the company and take it out later when your income's lower. So here's the plan that he thought he was executing. The company he set up to buy the property, for example, in that year, it earns a profit. It pays a company tax at 30%. And on top of that, based on his advice from the property gurus and the property gurus advisors, he can apply franking credits on day one. So in a lower tax year, he could pull it out cheaply. That sounds neat, right? But here's what actually happened. Life doesn't wait for your perfect tax year. 2 years later, he got married. Kids arrive, school fees jump, mortgage on the home that he owns personally increases, and also they want to upgrade to a bigger house. Now suddenly the question isn't, what's the most tax efficient year? It's how do I get cash now? So what happens is he declares a dividend. And let's put a number on that, right? The company profit distributed $100,000. The company tax paid is $30,000. And the franking credits attached is also $30,000. So on paper, it looks like the tax is done. But personally, he's still earning $190,000. So when that $100,000 from that company profit goes to his tax return, for example, he's got $100,000 of company profits. He gets taxed at $30,000. That's $130,000. And yes, he gets back $30,000 in franking credits. However, the grossed up income, and I'm just doing this math roughly, is around $130,000. What the TAX office does is they'll get $130,000 plus his $190,000 and add them together. Now you do your basic maths at a 45 to a 47% tax rate. His total tax owes around $61,000 to around $81,000 roughly, right? But again, remember, he paid the $30,000 in company tax. He still owns the difference personally in his own name. That's not a tax saving. That's actually a tax top-up. And here's the emotional punchline if you don't get anything from what I just said above, like you're totally confused. Ben over here didn't avoid tax. He didn't reduce tax. He just might have delayed it and complicated it. And you might be thinking, Q, well, why did he need the 100 Gs? Dude, he's a PAYG worker. He's on 190K. He has a life. He can't just retain all that money in the bloody company and not touch it for a while, right? Yes, if he was a single noob with no girlfriend because he's bloody fugly and no one will marry him and he'll just set along being a single noob buying all this property under a company, yes, very great tax treatment. But life happens. This person cannot just not take income from this company that's producing profit. He needs to live. Now compare this to Alex. Alex runs a very profitable business. and he earns 300k plus. And he only needs 120k to live, and he doesn't need dividends to fund his lifestyle. So when Alex leaves money in the company, it actually stays there and it keeps compounding. And there's no lifestyle pressure that forces it out. He doesn't need to pull that money out, which doesn't get mixed up with his personal tax liabilities. And if one day, if Alex chooses to pull money later, maybe after selling the business or slowing down or restructuring, that's a strategic decision. But for Ben over here, he didn't get to choose. In actual fact, life chose for him. And that's the uncomfortable truth about franking credits. I mean, franking credits are great if you genuinely don't need the money. For example, you can control the timing, your lifestyle is already covered, but it becomes very brutal if you rely on that money and your actual lifestyle actually accelerates expenses. So all in all, guys, this is a long video, but it's a very hard topic to explain in a very 30-second or a 5-minute video, right? So before you run off, let me translate the guru advice into plain English. When you buy in a company which ignores stamp duty, ignores land tax, and ignores cash flow, and ignores a clean exit, this is already assuming that you're already rich. No way. And most of the property gurus are targeting those rich investors, not you, the bloody noobs. But you know what happens? A lot of you noobs watch those videos, get inclined to book a call with these bloody property gurus, and get sold a strategy that is designed for rich Alex, but you're actually poor Ben. But again, guys, it's not malicious, it's not something they're untoward, it's just that you guys are bloody noobs. So like always, guys, structure should follow strategy, not those 30-second social media reels that get you guys to book those property coaching calls with those so-called property gurus, right? So if right now, if no one has walked you through how to get in, how to hold, how to get out, I'm telling you right now, you're not investing. You're just bloody guessing and most likely using someone else's strategy that isn't designed for you. So before you scroll away from this video, I want you to ask yourself, are you using someone else's copy and paste strategy? Or do you want a tailorized plan that fits according to your current life structure right now? So guys, if you watched thus far, if you want help, I suggest you book a 15-minute clarity call. That's like a triage call, very quick and fast for me to have a review. Or if you want more time with me, a 60-minute deep dive call. Or if you want my round table of Avengers help, the financial advisor, the accountant, probably the buyer's agent, and also myself, book in a 90-minute platinum strategy consult. And again, guys, I'm nearly booked out this week and also this month. And I want to say to you guys, the people who win, they don't just buy structures that are made for other people. They buy with a tailorized plan according to their life right now, so we can build from the foundation and hopefully end the generational poverty curse in your family and build generational wealth. But hey, if you're not ready, just like this video, hit a follow on this video if you like more videos like this, and most importantly, share this video because knowledge is power. And hopefully I see you in another episode of That's Property Roast.